Welcome back to the trading floor. I'm David Axtell. This is episode 13, and we're starting part 4, FX swaps. If you've been following this series, you've heard me say this product is the most traded instrument in currency markets. Over $3.8 trillion a day, more than spot, more than forwards, more than options. And yet, if you stopped 10 finance professionals on the street and asked them to explain an FX swap, 8 of them couldn't do it, maybe 9. That changes today. Let me start with what an FX swap actually is, because the name is misleading. When most people hear swap, they think of an interest rate swap. Two parties exchanging fixed and floating payments over years. That's not this. An FX swap is two foreign exchange transactions executed simultaneously in opposite directions with different value dates. That's it. 2 legs, 1 swap. The near leg exchanges currencies at one rate on the near date, typically spot T+2. The far leg reverses the exchange at a different rate on the far date. Could be tomorrow, could be 3 months, could be a year. You sell euros and buy dollars today. You buy euros and sell dollars in 3 months. Same notional amount of euros, different dollar amounts. The rate difference between the 2 legs is quoted as swap points. Why is the rate different? Because interest rates in the 2 currencies are different. If you're holding dollars for 3 months instead of euros, you're earning dollar interest rates and foregoing euro interest rates. The swap points compensate for that differential. Here's the critical distinction from a forward. A forward is a one-legged transaction. You agree to exchange currencies on a future date. That gives you directional exposure. If Euro USD moves against you, the forward has a mark-to-market loss. A swap is two-legged. The near leg and far leg offset each other. You're not taking a view on where Euro USD is going, you're temporarily borrowing one currency and lending another. The only cost is the interest rate differential, the carry. That's why swaps dominate. They let institutions manage funding and liquidity without taking currency risk. Let me give you a concrete example. A European bank has a euro deposit base, 300 billion euros of customer deposits, but they also have a $200 billion loan portfolio in the United States, corporate loans, mortgages, all denominated in dollars. They need dollars, they have euros. How do they bridge the gap? Option 1. Raise dollar deposits directly, open US branches, compete for American customers, expensive, slow, takes years. Option 2. Issue dollar bonds, commercial paper, medium-term notes. Viable, but requires documentation, investor relationships, credit ratings. Option 3. FX swap. Sell euros, buy dollars today. Use those dollars to fund the loan book. In 3 months, reverse the transaction. Get your euros back, return the dollars. The swap is instant, minimal documentation. You can do it overnight, for a week, for 3 months, whatever you need. And critically, no currency risk. Both rates are locked at inception. This is why non-US banks collectively fund over $13 trillion of assets through FX swaps. It's the lifeblood of international banking. Let me walk through the mechanics. Take a standard 3-month UR/USD swap. Spot rate 1.0850. 3-month swap points plus 27 pips. Far leg rate 1.0877. Near leg, settling spot, the bank sells 100 million euros and receives $108,500,000. Rate 1.0850. Far leg, 3 months later. The bank buys back 100 million euros and pays $108,770,000. Rate 1.0877. The cost, $270,000. That's the interest rate differential for 3 months of dollar funding. The euro amount? Unchanged. 100 million both ways. No directional risk, just the carry. Now here's where it gets interesting. Short-dated swaps. 60% of all FX swap volume is short-dated, overnight, TOM next, spot next, maturities measured in days, not months. Overnight swaps. Near leg settles tomorrow, far leg the day after. 1 day of funding. The EUR USD overnight swap market alone trades $800 billion daily for 1 day of currency access. Why? Because banks need to manage daily cash positions across currencies. Every day, payments come in and go out in different currencies at different times. An overnight swap bridges a 1 day dollar shortfall using surplus euros. By tomorrow, you've squared up. TOM next swaps. Near leg on spot, far leg 1 day later. The most actively traded short-dated variant, over 500 billion in Euro USD alone. TOM next is how dealers roll positions forward, how institutions maintain continuous funding without large notional re-execution. If you have a persistent dollar funding need, you can roll it daily through TOM next swaps. Each morning, yesterday's far leg becomes today's near leg. You execute a new swap extending funding by 1 more day. Roll, roll, roll. Continuous access to dollars without ever locking into a long-dated commitment. The cost? Tiny per day. A fraction of a pip for Euro USD overnight, but the operational overhead is real. Someone has to execute that swap every single day. Systems have to capture it, settle it, reconcile it. Spot next swaps bridge from spot to next spot, particularly useful over weekends when spot falls on Friday. And forward swaps have both legs settling in the future, neither on spot, used for more specific funding windows. Now let me explain swap points properly, because this is where many people get confused. Swap points are not a fee, they're not a spread. They're a mathematical reflection of the interest rate differential between two currencies over a specific period. If US dollar rates are higher than euro rates, holding dollars earns more than holding euros. The swap compensates by making the far leg more expensive, positive swap points. The base currency trades at a forward premium. If dollar rates were lower than euro rates, the opposite applies. Negative swap points, forward discount. This is exactly the same covered interest rate parity relationship we discussed in episode 10 when pricing forwards. Because a forward and the far leg of a swap are economically equivalent. Same pricing. Same interest rate maths. The only difference is that the swap has a near leg as well. But here's what makes modern swap markets different from the textbook. Since 2008, swap points don't just reflect interest rate differentials. They also include a cross-currency basis. The basis is a persistent deviation from pure covered interest parity, typically 20 to 40 basis points for major pairs like Euro USD, sometimes wider during stress. It reflects Basel III regulatory costs on bank balance sheets, structural dollar funding demand from European and Japanese banks, and the limited capacity of dealers to arbitrage the difference away. What this means in practice, if you're a European bank funding dollars through swaps, you're paying more than the theoretical interest rate differential would suggest. The basis is a real cost. And it has been a persistent feature of markets since the financial crisis. We'll go deeper into funding applications in the next episode, but the basis is something every treasury professional needs to understand. Let me talk about settlement. FX swaps have 2 settlement dates, near leg and far leg. Each involves full exchange of principal, both currencies, both directions. For CLS eligible currency pairs, and that's 18 major currency settlement, uses payment versus payment through CLS Bank. Both legs of both transactions settle simultaneously. No Hurst risk. We covered CLS in episode 8. For non-CLS currencies, settlement is bilateral through correspondent banks. That means you're exposed to principal risk during the settlement window. One party pays, then waits for the other party to pay. If the counterparty defaults in between, you're exposed to the full notional amount. That's a significant operational consideration, especially for large notional swaps in currencies where CLS doesn't reach. We'll revisit this when we get to NDFs and emerging markets later in the series. One more concept before I wrap up. rolling swaps. Many institutions don't do a single swap and wait for maturity. They run rolling programs. Continuous funding maintained by executing a new swap as each existing one matures. A bank with a persistent 3-month dollar funding need might execute a series of Tom-Next swaps, rolling daily. Or they might stagger 3-month swaps across different maturity dates, so one matures each month. As it matures, they replace it with a fresh 3-month swap. The advantage of rolling is flexibility. You're never locked in for long. You can adjust the size, pause if you don't need it, scale up during busy periods. The risk? Rollover risk. What if the swap market becomes expensive or illiquid just when you need to roll? What if the cross-currency basis spikes during a stress event and your funding cost doubles overnight? This is exactly what happened during the 2008 financial crisis, and it's why central banks established dollar swap lines, but that's a story for a later episode. That's FX swaps. Structure, mechanics, near leg, far leg, swap points, short-dated variants, settlement, rolling programs. The foundation for everything that follows in part 4. Next episode, we go deeper. How banks use swaps to fund their balance sheets in foreign currencies. Synthetic borrowing. The cross-currency basis in detail. And why the cost of dollar funding via swaps keeps European and Japanese bank treasurers up at night. This is The Trading Floor. I'm David Axtell. A reminder that the book behind this series, FX Cash Products by Luigi Rondinini and myself, is now available through all major marketplaces and directly from rondinini.com. FX swaps get a full chapter with worked examples, swap point calculations, short-dated variant pricing, and settlement mechanics. The kind of institutional detail you won't find in a podcast. For more depth, visit learn.rondinini.com. 122 professional mini-manuals, plus production-ready Python tools including swap pricing calculators, funding cost analyzers, and rolling program models. For corporate treasury teams needing strategic advice on funding, strategy, or swap program design, Luigi provides consultancy through rondinini.net. And for institutions looking for FX and treasury expertise, I'm available through axtellconsulting.net. See you in episode 14.